warm welcome to the FII View with me, Tanveer Gill. My guest today on the show is Vinit Sahni, who's Global Head of Professional Client Group at Deutsche Asset and Wealth Management. Vinit has nearly 20 years' experience covering large funds, hedge funds, sovereign wealth funds, asset managers, institutional clients, corporates and family offices. In the past, he has worked with large firms like Soros Fund Management, Goldman Sachs, Deutsche Bank, covering markets across asset classes with special focus on rates and currencies. Vinit, thanks very much for taking out the time and speaking with us today. Let me understand from you the money allocation trends that you're spotting right now. Now, you advise a whole host of ultra-high net worth investors. What is the mood like among them? Give us a sense of what is their approach right now towards risk.
Tanveer, first, thanks for inviting me on the show. It's a pleasure to be here. The mood's positive. They have cash on the sidelines. They're just waiting for corrections. They're absolute value investors, so any correction, any value, they want to invest. So in general, I expect them to stay positive for the moment.
When we talk a bit more about the emergence of this class of investors, the ultra-high net worth investors, or UHNI, so to speak, and the influence that they can have on global liquidity. So far, we've mostly heard of institutions and HNIs, putting in money into the markets.
It's a very interesting question. There's a lot of focus on the sector. If you look at the Billionaires Club, it's about $6.5 trillion. It's grown about 2.5 times since 2007. If you look at numbers, it's about 200,000 people, and it comes into like about 28 trillion. It's growing at about 2 trillion a year. So it's a growing class. Clearly, there's been a ton of wealth creation since the crisis. And they balance flows. They're long-term investors. They have permanent capital. That's critical. And therefore, anytime there's a lot of volatility, they balance it. So in general, it's a very positive flow for the market.
Do the UHNIs and family offices, according to you, have a different view on the markets compared to the institutions?
Yes and no. I think they are getting way more sophisticated, which means that they're moving closer to the institutional client base. They're strategic in a lot of views. However, when we step back a little bit, they have an absolute value bias, which means they look much more for absolute yields, and they're quite product agnostic. So on the tactical side, they may be quite similar to the institutional client. On the long-term investing point of view, they're quite different. So, but they're definitely moving closer to the institutional client simply because of the level of sophistication and the level of wealth that's gone up.
Also, give us a sense of what will the UHNIs do in the current environment. Are they more attracted towards equities given growth is picking up, or are they more attracted towards bond funds given that yields are high?
Listen, everyone thought 2014 was a year for equities. So clearly, they're slightly more biased towards equities. But if you just step back a little bit, on the macro side, they've invested into Europe. They're clearly in Japan, selective emerging markets. If you go down slightly and drill down into sectors, I think the sectors they've liked is clearly technology and healthcare. Biotech is one of the sectors they're very keen on. They've also been very active in industrials, financials for that matter. They're staying away from energy for the moment. They're sort of dipping their toes, but staying away to a large extent. And recently they've been dipping into utilities, but again, with the rate risk there, they've stayed away. So that's, there's a very strong equity bias. On the debt side, they're absolute value investors. So on investment grade, they're rolling, all the front end, all the carry trades they have, they're just extracting value there a little bit. But for new investments, they're typically rolling out the curve. They're going into 10 years, and then they're looking at yields. They're looking at the high yield sector to a large extent, simply because I think they're much more comfortable with credit risk than rate risk here.
And within bonds, are the investors more oriented towards pure interest rate plays, or are they interested in credit risk as well, essentially looking at the corporate side of the market too?
It's definitely on the credit risk sector. On pure interest rates, I think they're adjusting much more the liability side. So clearly, I think the bias is still short. And that's why when they actually look at pure interest rates, they'll buy 10-year investment grade. They'll roll up the curve rather than buy the front end. On the credit risk side, they're sort of spending a lot more time right now. They're looking at COCOs, they're looking at hybrids, they're looking at non-financial hybrids, they're looking at second lien loans, they're looking at covenant light. I can keep going on. All it tells you is that they're starting to weigh a lot more the implied defaults versus the actual defaults they're comfortable with. So definitely much more focused on the credit risk component.
What about their overall take on investment in EM debt and equity versus developed market debt and equity?
Let's look at where they stand on the EM or the flows in EM sector. We've got approximately 1 trillion in emerging market debt and equities within the mutual fund sector. I think 75% of that is in equities, 25% in debt. We've seen 33 weeks of outflows. Year to date, debt's lost about I think 10% of outflows, close to like 3-4% in equities. So, they've been very selective in the EM sector. I think a lot of the movements have come on debt simply because they feel real rates haven't adjusted. And that's why you see a lot more outflows in debt despite a lot of the allocations being in equities. So they're way more selective right now. They're looking at current account deficits. They're looking at real rates. They're looking at currencies which have depreciated enough so the economies can actually gain from it. On the developed market side, I think we've touched on a number of sectors on the equity side. On the debt side also, I think they're being a lot more active. Within credit risk, they're trying to see, where the value is. And also, one thing I'd like to point out is if you look at the linkages between the two, the sector in equities, which has a lot more exposure to emerging markets, clearly trades at a discount to the sectors that are much more developed market oriented. For instance, the average sort of PE for developed market equities, which have a lot more of emerging market exposure, is about 12.3. On the developed markets, it's close to like 14.3. And also, if you look at how stocks have done versus debt, if you look at the S&P, it has a lot more weight on emerging markets, and that's why it suffered compared to the biggest issuers in the investment grade sector. So, there's definitely linkages there.
Vinit, many believed that gold would do nothing in 2014. Could it be the contrarian bet this year, given that there has been risk aversion? Of course, we've seen that change over the last couple of weeks with the market momentum building up. But could gold see more upside?
It's definitely a contrarian trade. As a hedge, yeah, I mean, any sort of additional liquidity or any prospect where you may see liquidity continue longer clearly gives gold a boost. But I think there's some technical components to that also. There was one large central bank that bought close to 500 tons in the last 2-3 weeks, and that kind of spooked a few people. On top of that, you had this mini EM crisis, and effectively it got the technicals moving. Everyone was buyer short, at least on the smart money side. So clearly, I think there were technicals involved. If you look at just the long-term headwinds, there's a lot of production still out there. There's close to 3,000 tons coming on a year. ETF investors are still selling. So, in general, gold still has massive headwinds. So you may have these short-term spurts, but I think the overall trend is still lower. If you're of the view that you basically have the Fed tapering continuing, the UK economy coming back, and the economy is still in this kind of Goldilocks scenario where you have low inflation and decent growth.
Right. What is your advice to investors? I mean, how should investors approach asset allocation in this current dynamic environment? We started off the year a bit weak, but now it seems like the market is really defying gravity in the way it's moving up.
You've kind of hit a couple of very interesting points. It's definitely dynamic to the extent where the value is. So I think I would straight away go to active investing. It's not a beta game anymore. You really need to do your homework. You need to drill into sectors where you find value. You need to use the right managers, or you need to look at the right trades. You need to look at your portfolios risk adjusted for what liquidity is priced in, what volatility is priced in. I think a few of those sectors are mispriced. I would also look at credit risk premium. I would find ways to extract that. I would look at implied defaults versus defaults which you expect, and clearly take a view there. I think corporates are in good shape. You can actually drill down now slightly more because we're in the later stages of the credit recovery. I would also look at smart alternative strategies to capture liquidity premium. You can give up a bit of liquidity to pick up yield. As a long-term investor, you have that. So I would definitely use that, and just their liability and asset liability profile is very different. They have permanent capital. So, clearly they have a lot more staying power. So I would actually use that a lot more now. Last year, you could just be long the indices and, you didn't have to do the extra work. Now you can actually do that. So they clearly have a lot going for them right now.
All right, let me also get in your quick perspective on global markets. Market watchers are divided between extreme optimism versus extreme pessimism. What view do you hold for markets globally at this juncture?
I think that the positioning is extreme. I think the views are balanced. I think people still are in the camp that you have, gradual recovery, low inflation. So I don't think the positioning I think positioning is extreme. I don't think the views are that extreme. My personal view is that, you're still in the gradual recovery camp. I think there are a few things that are mispriced. The biggest thing that stands out, when I view risk in the global markets and I view where things are, is liquidity premium. I think it's completely mispriced to a large extent. I have a strong view there. But when I look at how the economies are moving along, I think it's quite predictable. Clearly there are some tail risks there, major geopolitical event or a massive revaluation or people reevaluating how they look at EM. But I think in terms of economies, I think Europe's coming along quite nicely, in terms of a cyclical recovery. I think US should bounce back in Q2. And, in Asia, we should see some structural adjustments. So clearly, my view is more balanced. I just think we need to be a little careful of some of the risks out there and how they're priced, so you're getting the right risk-just returns.
Right, but a lot of the optimism really hinges on what happens in the US this year. While the data is slowly improving, and we just saw the recent jobless claims numbers also being a bit impressive, there has been no takeoff, so to speak, in the economy, with the growth numbers really picking up. Does that make the bull rally in the US markets a bit unreal?
Not really. I think if you look at just the dynamics, Q has definitely pushed people up the risk spectrum. If you look at what's actually priced into the markets, we've had the third coldest winter, so clearly you've had a cold winter. Now, the market's given it the benefit of doubt right now because in similar circumstances in the past, you've had, stock markets in certain sectors like consumer discretionary has done worse, you've had certain cyclicals also do worse. So people are giving the US the benefit of doubt, clearly because, positioning was all skewed one way. I think they expect things to come back in Q2. I am seeing positive signs. I'm seeing business spending going up. Corporates are in good shape. They're starting to invest. Consumers are relevering. So there's some trends showing up. This showed up in Q4 data. I think it's a little blip in consumer spending, but that should come back, assuming the housing leg continues. So I honestly think they're giving the US a bit of benefit out here. The move down in rates is much more positioning oriented than anything else. You came into 2014 with some pretty extreme positioning. Everyone gung-ho, people short rates. So it's just an adjustment of that. But if you look at how the markets are behaving, I think, it's still very sanguine.
A lot of the much-awaited earnings growth, Vinit, is predicated on the deleveraging of corporate balance sheets, thereby leading to a pickup in investments. With rates expected to rise, what's your outlook on growth revival? Because these are two variables that work against each other.
Not really. I think you're seeing revival in business spending. That's been critical. Consumers relevering. At the end of the day, corporates are in good shape. Everyone knows the amount of cash they have. I think what people want to see is they exude a bit of confidence. They invest a bit, which means that they, instead of just buying back stock, and which they've been actually paid for right now, and people have rewarded them for that, they start investing. So the point is clearly you're seeing signs of business investment picking up. That's critical. I think people feel the consumer will keep chugging along as long as housing does well. So I think a lot of issues people had, things are starting to fall in place a bit. I'd like to see it continue a bit more, and the follow through is critical. But I'm quite comfortable with the view that business will start investing, and CapEx starts moving up.
Right. The last couple of weeks, especially the month of Feb, was fairly volatile for emerging markets with a downward bias, especially for currencies as well. But given your experience with rates and currencies, what do you make of the trends that you're picking up in the currency world, especially the rebound that we're seeing in EM currencies right now and the euphoria that's somewhat returning into emerging markets?
I think it's very clear. I think currencies, to a large extent, the move in currencies is to a large extent dependent on real rates. I think as soon as you revised rates expectations in developed markets, people started looking at emerging markets, and real rates don't look great. So you've had this adjustment in real rates. People have punished countries where real rates are too low simply because they're not getting the right value. Clearly they're more volatile. So when you look at risk-adjusted returns, you need to adjust for that, assuming that you take a certain amount of risk. And therefore, I think those countries where there's been massive concentration risk, they've suffered because the windows to liquidity, I still feel, are quite small. As soon as that adjusts, I think certain emerging markets will be rewarded. And people will start differentiating, and also current account deficits. People are very focused on that right now. So, I think it's a function of three things, to a large extent. One is where rail rates are. Two, to a large extent, where the current account deficits and the financing needs are. And three, to a large extent, how much the currencies have depreciated and how they are valued, so that it kind of helps the export sector. Because if the export sector doesn't get helped, then you basically have to reduce imports, and it affects things. So I think people are being much more selective about where things are, which is the right way to approach things.
Right, but what, according to you, can spook the party for the US markets? It's looking very good for now. What can change?
I think the three key risks, well, I'm not sure if three is the right number, but the key risks clearly are one, on the rate side, two on the earnings side, and three on the volatility side, because that affects people's expectations. On sort of the rate side, inflation is something to watch out for. Everyone's kind of written it off. There's some temporary persistent factors in inflation, like owner's equivalent rent, which is starting to move up, and it should move up. That's 29% of CPI, less in some of the Fed indicators like PCE deflator, but I think that's critical to watch. If that moves up, clearly central bank policy is at risk, and that affects things. On the earnings side, we need to see business invest. We need to see that follow through. We need to see some of these optimistic forecasts being realized, so that's critical. On the volatility side, we need to see less event risk. We need to see less geopolitical risk. We need to see less risks in overall markets, because whenever there's a move in markets everywhere, people adjust risks, people adjust their flows. So these are three key components to watch out for, which will affect the US markets.
Your overall view is a bit cautious. What risks, top of the mind, worry you the most at this point?
Liquidity. I think on the liquidity side, I think people need to start pricing in liquidity, that if there is a shock to the system, are they really positioned for liquidity? I mean, we've seen a big explosion on the buy side, where there's been a lot of issuance in the last 2-3 years, and the sell side has been contracting. So people really need to look in their portfolios, and that's why it comes back to active investing. Is at a time like this, they need to also protect their capital, because carry's coming down, coupons are not the same as they were 3-4 years ago. So the point is, I think people need to start watching this. They also need to, watch out for any signs of trouble, any signs where you can have potential contagion. I think they need to be selective in EM. They need to be, much more smart about how they invest. They need to, at the end of the day, we're in an environment right now where we're pretty much priced for perfection. So I think a lot of the things we've covered, they need to be, but one thing I'd like to focus on is on the liquidity side. I think they really need to start pricing that risk premium.
Well, a lot of emerging markets are hiking rates to protect their currencies, and that could be a bit of a risk to global liquidity. What is your view on that in the near term? And also, what would that mean for the markets?
Clearly, they're raising rates to protect the currencies, and we've seen Brazil do that, India do that, we've seen Turkey do that in a big way, and South Africa do that. So clearly, it will have an impact on growth. The key is, how do the business model adjust? The current accounts, if people feel that rail rates have gone up enough, they'll reward the currencies. If they feel current accounts have adjusted enough, they'll reward the currencies. And in that case, what happens is, you clearly have more investment. If the currencies depreciate enough, the exports do well. And clearly, if things stabilize, they can again start reducing rates. In India, for instance, inflation is starting to come off. So they've been. I think it'll clearly have a short-term impact on liquidity in these countries, but it's how they adjust to it that's a critical component.
Okay, let me get your views on emerging markets at this point. Within EMs, where are you most bullish? BRIC really seems like the default option compared to the rest of the emerging market pack, especially a debt-laden, risky Argentina and Turkey.
Within BRICS, I'm personally bullish in China. I like India and China for the moment. I think China is clearly balancing reform and growth. I think they'll come through. I think clearly there are going to be some hiccups. They're starting to make the right signs. They're starting to, push some of the speculative flows away. On India, they've made some good moves on the current account side. Clearly elections are a big risk, but the central bank governor is very credible, and he's made some really good moves. I like Mexico. I think Mexico's got some real positive headwinds. 2015, clearly is a big year for them. They'll get massive energy-related inflows. The FDI flows have been strong. If you look at Mexico, China, the exchange rates, Mexico's depreciated 50%. Why it's important is, clearly they're much more competitive right now, and they're getting a lot more corporate flow coming in. So there's real basis. Why is it weakened? It's because they have a lot of concentration of foreign ownership in the domestic sector. And the second component is they're seen as a proxy on the LATAM sector, and they're one of a few deliverable currencies. So, they get hit in terms of any contagion. I also like Korea. I think Korea's stock market's gotten beaten up. It looks good. The growth is strong, 3.9%. So, selective markets I like.
Well, how are you viewing the volatility in emerging markets from the start of the year till now, Vinit? Because, off late, of course, the last couple of sessions, it's been a roaring rally, really. All-time high levels coming in for the Indian market. Emerging markets are rebounding. But, what we've seen from the start of the year till now is that it's been pretty much volatile for EMs. Do investors see every dip in emerging markets as an opportunity to buy or a sign of more trouble?
I would ask them to be very selective and careful, look very seriously at where the value is. Again, I keep coming back to this. I'm a big, when I look at a long-term investor, I really want them to start looking at fundamentals. I want them to start looking at, where real rates are, what's the fundamental backdrop. So, those are key components. They have to be cautious of liquidity. I think the last few weeks, what they've shown us is the windows to exit are quite small. So, it keeps coming back to this. I want people to really focus on some of those things.
Right. How is India being profiled among emerging markets, especially within Asia at this point, given the market is at record highs?
It's positive. I'm positive, and I think you can see the way the currency is reacting. It doesn't have the same volatility some of the other EM currencies are having. I think people are definitely happy with what the central bank governor is doing. Rajan's taken some really good steps. If you see positive developments in current account, I think those are important for India. It's literally halved in the last 6 months. Elections are a key risk, so no one's jumping in a big way. I've seen some switches where people are selling some debt of Chinese banks, they're buying Indian banks. I've seen the same out of Korea into India. So people are starting to make some inroads, but they're a bit cautious ahead of the elections.
All right, Vinit, thanks very much for joining us and giving us your perspective on the markets. Really appreciate your views. With that, we come to the end of this edition of the FII View. Thanks very much for watching the show.